Fed's decision just minutes away. Joining us are David Kelly of J.P. Morgan Asset Management, Kristen Bitterly of Citi Wealth, and Jim Caron of Morgan Stanley Investment Management. Let's talk a little bit. Welcome first to all of you. David, let me begin with you and just sort of get your thoughts as we head into this meeting. I know that you are sort of in the camp that says there ain't nothing coming, but we got to listen to what gets said.
Well, yeah, I mean, when it comes to interest rate cuts, I think the Fed's basically ready, set, wait. And so we're just going to have to wait a while here because inflation, the last few inflation reports on CPI, just a little hot, the ECI number a little hot. So I think the message is going to be, look, we don't think we're going to have to raise rates again, but we're going to take our time about cutting rates. And they want to give that sort of generally hawkish message that they just don't have any tolerance for sticky inflation and therefore they're in no mood to cut right now.
Kristen, so what could be the worst thing the Fed could say in its statement or in the press conference that would spook the stock and bond markets? What would be the danger word?
I think the danger would be two things. One is that inflation is more entrenched, and two, Chair Powell is going to be asked about whether a rate hike is on the table. And so anything that would allude to that, I think you would see a market sell-off. That being said, I don't think he's going to do that. I think exactly as David mentioned, this is going to be, we're data dependent. We still see the trends overall going in the right direction. We didn't have the data that we needed within Q1. So we need a more disinflationary trend to begin our rate cutting cycle. But I don't think there's going to be too many surprises.
Let's talk a little bit, if we might, about, Jim, the idea of slowing down the runoff of the balance sheet. Do you expect there to be much commentary on that? And how important is that if we do hear?
I think there will be a question on that, and that always comes up. It is important, but I think it's also very forecastable. I don't think there's going to be any surprises on that. I think really the surprise factors are going to come in terms of like what I call a crisis of confidence at the Fed, meaning that there's a crisis of inflation confidence in terms of what this bumpy path means towards lower inflation. How long are they willing to give it, or do they have to reset the inflation clock now and need to see 3 months in a row at least of low inflation prints in order for them to regain that confidence? So I think the balance sheet runoff is going to be important, but I don't think that's going to carry the day today. I think that's going to be just well baked into the news.
So, David, let me come back to you very, very quickly with the same question I asked Chris in there, which is, what would be the scary words that could come out of this?
Hike. I mean, if the Federal Reserve were to say that they're thinking about hiking rates, then that would say not only that we could have higher rates, but also the Fed would be admitting that they somehow got it wrong. I don't think they're going to do that. I think they desperately want to stay where they are for a while and then cut rates this year. So the worst thing they could say, though, I think for markets would be that they're actually contemplating a hike.
All right, we're going to come back to the panel in just a moment. Meantime, let's go to Steve Leisman for the decision.
The Federal Reserve leaving rates on hold in the range of 5.25% to 5.5%. It does note a lack of further progress on inflation in recent months. The prior statement had noted that there had been progress. It says the risks to achieving the dual mandate have moved towards better balance in the past year. Note that they had said before we're moving, so that's another kind of reference to stalled progress on inflation. It repeats that it does not expect to cut until it is confident inflation is moving towards that 2% target. It reduced the quantitative tightening runoff to $25 billion from $60 billion. Pretty aggressive reduction there, and that begins in June. A way to think about this is, if my numbers are right, it's a runoff that had been going at $720 billion a year of treasuries, by the way, down to $300. It left the runoff of mortgage-backed securities the same at $35 billion. Again, that QT goes from 60 to 25 on treasuries and begins in June. That is a cap on the reduction. On the economy, the Federal Reserve continues to say the economy is increasing at a solid pace. It says job gains have remained strong, repeats that inflation has eased, but again noted that progress has stalled. And I'm going to repeat some statements that they repeated this time around, but maybe now they're perhaps more important. It said the committee strongly is committed to bringing inflation to 2%. They're highly attentive to the inflation risk, and they're prepared to adjust policy as appropriate if risks emerge. Those have been in the statement for a long time, and maybe now they're a little bit more important. Tyler, back to you.
I'll give you a few minutes to dig a little deeper into those words and think about the effect of them. Let me come back to you, Jim, and we're going to get back to our panel for some reaction. We're also going to welcome in Rick Santelli and Bob Pisani. Why don't I just go to you, Rick, and get your quick thoughts.
You know, there's been some volatility in the 2-year, the 5-year, the 10-year, the 30-year, and the dollar index. But net out of the volatility, we saw up yield, down yield. But we're virtually at the same spot as before Steve read the statement. We're starting to drift a little lower, and I think that speaks volumes. Interest rates have come down from some of the peak levels earlier today, but they're up on the year, very close to some of the highs. And if you go back to the last meeting in March, we're significantly higher when we were then. I think that the salient feature here is simple. We have a stagflationary environment. Growth isn't bad, okay, but it is definitely moving a bit lower. The glide path seemed to be lower, and we know that there's not only sticky inflation, there's pockets of inflation that are going up. Even though we seem to read that so quickly, nobody could hardly hear. But I go back to the same old song and dance, okay? My song and dance is easy. If you look at the last 2-year, 69 billion record size, last 5 years, 70 billion record size. The first primary auction of 10s in February at 42 billion record size. We have 818 billion now to service the debt, on its way to $1 trillion, and we're at 34 trillion in debt in the U.S. We're 312 trillion debt in the globe. To me, the big feature here is sticky inflation is going to meet rising debt levels, and it's going to leave the government very little wherewithal to jockey around discretionary spending. And this all comes at a time where I know we're cutting back down to 25 billion on runoff, and also, like in Poltergeist, they're back. Buybacks are back. That was part of the Treasury announcement today. So we have QT ramping down, buybacks moving up, even though we're not easing. It's been voiced as a liquidity issue. I'm not sure. Liquidity issue really seems to be synonymous lately with rates going up quickly, but maybe they're going up quickly because spending's going up quickly.
All right, Rick, thanks very much. We'll come back to those thoughts in just a minute. Bob Pisani, let me turn to you with the equity market reaction.
Very small. S&P was down 11. Now it's only down 5. The key sentence here is in recent months, there's been a lack of further progress toward the committee's 2% inflation objective. There's the higher for longer. And the issue is, are rates sufficiently restrictive to keep bringing down inflation? That's what we're not sure of. The bond market seems to think that there might be higher rates coming. The stock market, I can tell you, is very afraid of that. Remember what happened last year when the 10-year moved towards 5% in October? The stock market fell apart. We're at 4.6. heading towards 4.7. If we go to 5, I can tell you the stock market is not positioned for a 5% 10-year yield right now. So that's a great fear. To the extent that they did not put hikes on the table or clearly indicate that, that's a positive read right now. Broader term, the debate down here is the biggest threat to stocks the fact that disinflation is not occurring fast enough, or is there a slowdown in growth? People are a little spooked by these earnings reports from McDonald's, Starbucks about a slowing consumer. My own sense is the low-end consumer is having a hard time. The higher-end consumer is not at all. So right now, I'd be much more concerned about the inflation outlook than I would be any slowing with the consumer. Guys?
So, Kristen, Rick let slip the word. I know it was intentional, but very intentional. A word that has been in my head for some weeks now, and that is stagflation. Is that where we are right now?
I think it's too soon. I think we have to go back to looking at the second half of 2023 and the data that we had. So when we see the third quarter and the fourth quarter, we had really strong GDP. We also saw disinflationary forces that were really, really strong and better than anticipated. Q1, you saw a little bit of normalization, right? So you saw inflation not coming down, CPI certainly not where we wanted it to be for Q1, but I would call that more normalization. Even the GDP print that we saw that came in below expectations, when you factor out imports and you factor out inventories, all of a sudden it looks like a pretty solid GDP print. So I think this Q1 was about normalization, and the data in Q2 really matters for the Fed's trajectory from here and the overall economic backdrop.
Jim Caron, the fall off or the runoff from 60 billion a month to 25 billion may have been a little bigger than some people expected. React to that, and what in a practical sense does that mean to the markets and to consumers and the general public?
Well, look, I mean, I think Rick summed it up. There isn't much of a move in the rates market right now, and I think that's exactly what we should be focusing on. We're anticipating that the Fed's balance sheet is going to adjust, and I also think that a big balance sheet is a form of easy policy, so I think this does need to adjust over time. But Tyler, let me go back to what I said before, which is that this is really about resetting the clock for the Fed. When do they start to get confidence that they can actually start to cut rates? And this is the debate that's in the market at this point. So the debate is whether or not they, if you go by market pricing, is the first cut in December, where many forecasters still think July. And I think the fly in the ointment is going to be the labor report. If the labor markets start to weaken, I think that advances the time scale for the Fed to start to cut earlier. But if the labor market stays strong, I think that they're going to stay on hold probably until December.
All right, so Steve Leisman, let me just get any further thoughts that you might have, having a little more time to read the statement and pull your thoughts together.
Well, I have a hard time seeing this as stagflation or in any way, shape, or form. Stagflation is high unemployment. It's high inflation. It's no growth. We are so far from any one of those three. Not that it couldn't happen, but stagflation assumes something is sort of broken in the price mechanism in the economy. And what would be broken there would be that if you do have weaker growth, prices would not adjust downward. We don't know if that's the case. I just think we're a very long way from stagflation. As for the Fed, I would say this statement reads to me like a plane that's circling. They're waiting for time. They've acknowledged there are a little bit of turbulence in the air there. They perhaps see some fog on the runway. So they're not quite ready to land yet, but I do think they want to land this plane. I think they're still on course to try and land the plane, Tyler. It's just that this is a holding pattern, this statement here, before the data either breaks towards weaker growth and lower prices, and or you get a move higher in inflation, which would engender a different kind of response from the Federal Reserve. But what the Fed is doing here is essentially holding.
David Kelly, let me get you to react to what Steve just said. Are we far away from stagflation? Are we nearer to it than might be comfortable for the Fed? What do you think, or is that really just not even on the table?
No, I think I completely agree with Steve. We're very far away from it. I mean, we've got unemployment below 4. We've got consumption deflator inflation below 3. 3 plus 4 is 7, but 3 plus 4 is also good. These are good numbers for the U.S. economy. Growth is slowing, but it's slowing at a modest pace. So really the economy is fine here. There's nothing wrong with the economy. It's just all a little too hot for financial markets who are banking on big rate cuts from the Federal Reserve this year. But even the statement, I think the one thing that strikes me is they could have cut the Treasury runoff from 60 to 30. The fact that they went that extra $5 billion, it probably doesn't sound like a lot, but it does say that they're trying to send a message here that they're not going to be too hawkish here. So if anything, I would regard this statement as being slightly on the dovish side, and it gives me more confidence that they won't hike again, but they will eventually cut rates this year.
I'm going to come back to all of you or several of you on a terminal question here about the terminal rate of interest rates. But Rick, let me just turn back to you for any reactions you have.
You know, to me, it's not that my sources or many people I have confidence in to gauge the future of the economy are saying stagflation's here. What they're saying is it's a rate of change argument. It's impossible to look at the GDP report and not say that growth is slowing, the rate of change is slower. So yes, the economy's fine, but it's much less fine than they thought it would be. It's much less fine than the previous quarter. And if you looked at the pricing components in the last GDP report, inflation, the rate of change is moving back up. So it isn't that stagflation's here. It's that you can't put your head in the sand. Okay, we had guidance from a dovish Fed that was very wrong. Okay, didn't hear much grumbling about that. But to have forward-looking notions regarding the glide path and rate of change of the economy that may point to stagflation, that to me makes sense. And I don't think we should ignore our eyes. Our eyes aren't lying. Things are slowing but still growing, and inflation stopped going down. You could call it anything you want, but what you can call it is a reason to ease.
How about what Rick just said? Who would like to react to that?
Well, I'll say something. Just briefly, Bob. Just from the stock market's point of view, I cover the stock market here. The reason the S&P was down 4% in September was not because people were concerned that earnings or the economy were falling apart. The concern was higher for longer interest rates would bring down the multiple. So instead of 21 times forward earnings, we went down to 19 and change because higher for longer, of course, impacts future stream of earnings or the perception of the future stream of earnings. Now, if there is some kind of slowdown in the economy, which we don't see yet, or the job market slows down, then the earnings numbers themselves are going to start coming down, and that's a whole other scenario.
Yeah, but Rick says we are seeing a slowdown in the economy. Rick said you got to look at the numbers; they are slower.
Here's the thing:
the jobs numbers, which is what matters, are still pretty robust.
I'm going to let Steve jump in, and then Jim. Steve, go ahead.
I'll keep it quick. The idea of that means stagnant. It means we're not growing. A slowing in the pace of growth is what we all have wanted. It is the soft landing scenario. So it would seem a little bit extreme to me to jump from we got the slowdown we wanted to the idea that the plane is stalling and about to crash land. Look, I think Rick is right. You got to factor that into your possibilities. I just don't think it's the most probable outcome because of what you expect to happen with prices in that scenario. In a scenario of stag, you get D, not inflation.
All right. Well said. Jim, I want to get your final thought, and then I'll go one more time to you, Kristen and David. Jim?
So look, I think it's premature to talk about stagflation, but there's a lot of noise out there, so let's focus on the signal. Tyler, you were going to talk about the long-term terminal rate. I call that the forecastable horizon of Fed policy rates. What the market has been very stable on is that the market still believes that the Fed policy rate's going to 3.5% to 3.75% sometime by 2026. How we get there, how quickly we get there in 2024 and in 2025, there's going to be a lot of debate about that, and there's going to be a lot of noise. But what keeps the market stable, equities and fixed income, is if that longer-term forecastable rate stays stable. And right now it's staying stable despite all the confusion in the markets, and that is actually a blessing for asset prices at this point. If that rate moves higher, that could actually spell problems.
So that's where I wanted to end things, and that, Kristen, why don't I turn to you about that long-term terminal rate for interest rates. Jim just said 3.5, 3.75 by 2026. That's a little higher than we've been accustomed to over the past decade and a half, but maybe it's just not too hot, not too cold.
Exactly. I think it's higher than what we've experienced, certainly, and it's higher than what expectations are. I think since we've seen resilient growth, and I'm going to go back to something that Steve said, where it was, we are seeing a decline in the growth rate. We're not seeing a contraction. We're seeing a slowdown in growth, which is exactly what the Fed wants to see, whether that's the data that we've seen in GDP, whether that's the data that we saw in JOLTS this morning. And so finding exactly what is that neutral rate and what is that balance is something that I think the Fed is going to take its time, and it's going to do it gradually in terms of the rate cuts that we'll see in 25 basis point increments, that if we get the data from an employment standpoint, we get the data from a disinflationary standpoint, we'll still see maybe even up to 3 cuts this year.
Mr. Kelly, you get the final word.
Okay, I do think the terminal rate ought to be higher because I think that 2.6% is too low for financial markets. But on the state of the economy, I know the numbers are getting a little worse on inflation temporarily, but that's kind of like saying, a teenager gets older every day, doesn't make them old. And so this economy is really much more like a teenager than an 80-year-old right now. It's an economy which is showing plenty of potential for growth. Inflation, I think, is still sticky, but probably trending down. Unemployment is very low. This is actually a pretty good economy for Main Street. Not quite as good for Wall Street if you really want short-term rates to come down to 2.5%. But frankly, I think this is a glass, not just half full. This is a glass about 80% full here.
All right, that wraps our conversation. Thanks to our panel. Lively conversation. We stirred the pot a little bit there. Thanks so much to all of you for your participation today. Really appreciate it. All right, coming up, we will get more reaction to the Fed leaving rates unchanged. We're going to get reaction to the Fed doing nothing. No, that's just a flippant way of saying it. We're minutes away from Jerome Powell's press conference. There, you will get a real chance to hear the thinking behind the Fed's actions today, or non-actions. We'll take you live, but first, a quick break. All right, welcome back. Let's get a little more reaction to the Fed. Rick Santelli is back. I feel a little guilty, Rick, for maybe putting words in your mouth on stagflation. But the essential thought was really whether we're at stagflation now or not. Your thought was, and I want you to elaborate, was the idea that you've got growth slowing at the same time that the decline in inflation is abating and maybe moving back up. And so it may be a low probability that we get to stagflation, but you can't dismiss it out of hand.
No, listen, Tyler, there was a lot of ifs and maybes that our guests put forth, okay? Maybe this will happen. I'm a numbers guy, okay? I look at the numbers, the hard data. GDP in the first quarter was 1.6. In the fourth quarter last year, it was 3.4. That is much slower. And if our guests say, well, wow, 3.4 was too strong, I understand that. But what was the consensus call? 2.5%. We got 1.6. I'm a numbers guy. That's slowing. And if we look at the GDP price index, it was 3.1. Okay? Last look, it was 1.6. And the core was 3.7 versus 2%. There is no denying the hard numbers. Now, we could question whether the numbers the government puts forth are accurate, and many who look at the labor markets don't think it is. But I will go with the numbers. I don't like changing midstream. So it could be a consensus call that stagflation's a low probability, but it's a significantly higher probability than it was a month ago and much more significantly higher than it was a year ago. And once again, the guidance from the Fed has been very wrong. People want to blame the markets. You could say dot plots. You could point to anything you want. But even the Fed chief Powell has had a lean towards move. They still have a lean. The question isn't whether they're going to ease. It's that they're going to ease. Well, what if inflation goes to 4.5%? So I'm a hard numbers guy, and the numbers do not back up most of the conversations I hear.
Well, he will certainly be asked, won't he, in a few minutes' time, in about 8.5 minutes' time. He will certainly be asked whether there is a possibility that inflation resurges and he has to raise rates.
Yeah, you know, that's not my base case. And to be frank, my base case isn't necessarily stagflation. But I think that if you have a runway long enough right now to consider all the moving parts, I cannot dismiss how debt is a growth killer. And it's not only domestic, it's global. And it's only going to get worse. Even the IMF's numbers have some global growth kicking up a little bit potentially in the next 12 months. But if you look at their longer-term prognosis, debt is going to dwarf growth, and it's going to be like an anvil on top of the shoulders of growth.
Well, I worry, too, about the volume of debt that we've added to the economy, and now at higher interest rates, how much more we're having to pay to surface that debt. Let me come back, though, to the stagflation discussion that we had in the prior block. If I discerned from sort of that panel's discussion that it was that, well, yes, the economy is slowing, inflation may be sort of plateauing, but this is the soft land. This may be the soft landing that everybody was hoping for. How do you react to that?
You know, I just think it's too early to tell. I can't tell if we're going to have a soft landing. If we get a CPI that moves up significantly, soft landing could go out the window. And it isn't only about the soft landing, just your discussion about what the terminal rate needs to be. There's no way to really tell what the terminal rate needs to be. There's no way to tell what it will be. So some of these variables that are so intricate in plugging into the Fed's models are just assumptions, and we really don't know. And anybody who's looked at how many variables, the Wall Street Journal did a report on this. I forget how many variables are in the econometric model that the Fed uses, but there's a boatload. And I'm not saying that it isn't the best model on the planet. I'm just saying that we don't know how much air we're going to have, and a little bit of air in the marketplace has a huge distortion when you move 2, 3, 4, 5 quarters down the road.
Tell me I'm crazy, Rick, which many people are more than willing to do, but about this sort of assertion. Neither the Fed nor the Fed futures market have been particularly good about predicting what's going to happen. The Fed was talking about transient inflation for a long time before they took the word transient out of the conversation. Now the Fed basically is saying, well, we're going to be ready to cut rates, but now maybe not so soon, not so fast. The market, similarly, last fall, thought there would be a lot more rate cuts coming this year than the market says today. So who's the good predictor here of either what the Fed is going to do, what inflation is going to do, what the economy is going to do?
You know, Tyler, if I tell you that the Chicago Cubs are going to have 3 pitchers that are going to win 30 games this year, you'd probably raise the chances of them going farther down the season and doing better potentially and making playoffs. Well, what if the pitchers don't win 30 games? See, here's the issue with those predictions, is that the market is listening to the Fed. The whole premise of Fed guidance is to guide the market by the nose, okay? And when you still have a huge balance sheet, when you're still tinkering with rates, how can the market actually rise to the occasion and accurately price risk? In my opinion, 4 weeks ago, you did not see an ease in today's Fed meeting. That's what the Fed contract is good for. And anybody who thinks that looking today is going to give you an accurate picture of July, Sep, Nova, Ds, and Fed fund futures, I think they're misguided. It really is for the next meeting and only when you get within 4 to 6 weeks. And if you look at that as the criteria, the contract's almost infallible. What we are looking for that contract to tell us is impossible, okay? And just because traders are putting their money there, it isn't that it's wrong. It's that the Fed is positioned them that way. And in addition, the Fed fund futures contract and options, in large part, may be a hedge. And the hedge doesn't necessarily give you the entire picture.
So what I'm hearing you say there is that the market in its predictive value is kind of like a long-range weather forecast. It's going to be a hell of a lot more accurate predicting what's going to happen tomorrow or a week from today rather than what's going to happen a month or 8 months from today, correct?
Bingo, you nailed it. That's it.
On that, if I get an A from Professor Santelli on anything, I'm gonna appreciate it. All right, Rick, thanks, my friend. All right, let's get some final thoughts as we count down to Fed Chair Powell's press conference. Mike Santoli joins us as well as David Kelly. David, why don't you kick it off? I don't know whether you heard the last part of that conversation. I asked Rick fundamentally, who's the better predictor here of what rates are going to do, what the Fed is likely to do, the Fed, or what inflation is going to do, the Fed or the markets, or are they both equally wrong, equal amounts of time?
Well, I think you're both spot on that it's like predicting the weather, 10 weeks out. But investors should invest based on the climate, not the weather. And we generally have got a good economic climate here. We've got a climate which seems to allow steady economic growth. I do think that inflation will gradually moderate as it did for many decades before the pandemic. And the unemployment rate seems to be pretty low, and workers don't seem to be demanding huge wage increases. So the climate's pretty good. The weather's going to bounce around, but long-term investors, shouldn't play the trading game here. They should invest based on that climate, which, as I said, I think is pretty positive.
Good wisdom there, Mike Santoli. Your reactions to the Fed decision and what we might expect to hear from Chair Powell.
Yeah, clearly the market is taking it as the Fed electing not to turn more explicitly hawkish. There was perhaps some idea that it might do that. It just acknowledged the data that's happened in the 6 weeks since the last meeting. And of course, in those 6 weeks since the last Fed meeting, 2-year yields, 10-year yields are both up 40 basis points or so. So there's been some market, tightening of financial conditions. The Fed wants to preserve optionality, keep its options open as it usually does, and that does mean being data dependent. So I think that that's sort of better than we could have feared, perhaps, from the market perspective. The issue to me is the bond market has implicitly been testing the economy's tolerance for higher yields, as the Fed has been testing the economy's tolerance for higher short-term rates. So far, it's been okay, but we're searching for this new equilibrium out there. And I do think that in the press conference, what the market would like to hear is that Powell still thinks you can have inflation continue its decline without undercutting economic growth. That was the main premise of the December pivot. And if he sort of goes back on that and starts saying, well, maybe the services sector really does have to be restrained more to get wage growth down, and I don't think the market wants to hear that there's going to be that economic cost for a resumption of disinflation. I also think they want to hear him point out that PCE inflation is not terribly far from where the Fed thought it was going to be by the end of this year at the latest reading. Remember, there's no dot plot in this meeting, so there's none of that he has to kind of dance around in his response.
Quick final thought, Mike. The Dow, and maybe peculiar to the Dow, seems to be reacting in a rather sprightly way. It's up 200 and some points right now.
Yes.
Go ahead.
I was just going to say all the indexes did actually get a lift on the statement. Of course, Fed day reactions sometimes can really be very much a Quicksilver type of thing. You don't know if the first move is the right move. But I do think that's because there was an absence of incremental hawkishness. Plus, you had that further decline in quantitative tightening, perhaps beyond what people were projecting.
Yeah, and of course, David, I asked him what the trigger word would be here, and he said hike, anything having to do with hike. And so, David, you were right there. That word has not come into play yet. It will be interesting to see, however, how the chair handles questions about whether an interest rate hike was even discussed in their meetings.
Yeah, he's gonna have to play that one very carefully. I think he'll have to admit it's always possible to raise interest rates, but their base case is still just about the timing of rate cuts, not the option of hiking rates.
And your base case, sir, just once more for the record.
At the moment, 1 or 2 rate cuts, nothing before September, maybe nothing before December, but some cut this year.
Let's go to the chairman of the Federal Reserve, Jerome Powell.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also look at we look at surveys of workers and surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for...
Expectations are not anchored?
Or anchored.
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
I don't want to get into complicated hypotheticals, but I would say that, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina. Thanks for taking our questions, Chair Powell. I wonder, obviously, Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. Our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
Would that be like a reacceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%, and another path could be an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. The thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably, that's what we're tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. Rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply-side distortions and demand-side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. what we've said is that we need to be more confident, and we've said, my colleagues and I today said that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months' data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking.
Steve.
And Mr. Chair, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter, and what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view, I think, that in fact we didn't gain confidence and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened, and I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates, and this is a plan we've long had in place to slow, really not in order to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one. It doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Torres from Bloomberg. 2 questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth that's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it would be appropriate to cut until we were more confident that inflation was moving sustainably on 2%. We didn't get, our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's, the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them is further away from goal than the other, then you focus on that one. It's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation, and this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it, and that's how we think about that.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It would be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run there are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year for that matter too. So I think in that case, I think you really do have a significant increase in potential output, but you've also got, so you've got more supply, but those people also come in, they work, they have jobs, they spend, so you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive, and our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years, and that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Edward. Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
Yeah, I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria. Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. You worried. Nancy. Sorry.
Hey, Chair Powell, Nancy Marshall from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at, anyway, headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes. I mean, I think that restrictive monetary policy is doing what it's supposed to do, but it's also, in this case, unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation, and the reason why we're having this conversation, is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember, how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably a significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very of course, gratified and pleased that that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not, it's not, frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group around the people, frankly, more diverse than it used to be in many dimensions, more diverse from the obvious, gender and demographic ways, but also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question though. Thank you very much.
And welcome to Closing Bell. I'm Scott Wapner here, Post 9, New York Stock Exchange. And as we hit this final stretch, seems pretty clear the markets did not get the more hawkish Fed chair that it had feared and perhaps even prepared for in the days leading up to this moment. Though Chair Powell cited a, quote, lack of progress on inflation in recent months, he said longer-term inflation expectations remain, quote, well anchored. He said he still expects inflation to move down as the year progresses, especially in housing. And importantly, he all but took a hike off the table, calling those prospects, quote unquote, unlikely unless something dramatic were to happen. We check the markets now. Clearly, the market's taking this as a bullish event today, at least for this moment. You see the Dow there. Almost everything is higher by at least 1%. Interest rates coming down a touch. No surprise that you would see the Russell 2000 doing quite well. Dollar sold off. There's your interest rate picture. Those are falling a bit as well. So let's bring in Jeffrey Gunlach now, the CEO, CIO, co-founder of Doubleline Capital. Jeffrey, it's good to see you. Welcome back.
Nice to be back on Fed Day, Scott.
Yep, and it's good to have you. First and foremost, your reaction to what we just saw.
Well, I think you just said the most important word, which was unlikely. Unlikely the next policy move will be a hike, and he went quite out of his way to make it sound like they're not contemplating a hike at all based upon the data that's come out, even though he's being a little bit disingenuous by claiming that inflation is below 3%. Remember back at Jackson Hole in 2022, I think it was, we came up with supercore inflation, supercore CPI, supercore PCE, and supercore PCE, which is excluding food, energy, and housing, is up 3.3% year over year. And what no one wants to talk about is supercore CPI is up 4.8% year over year. In fact, the CPI for the first quarter here in 2024 at year end was projected to be 2.7 on an annualized basis. And instead, it's 3.5 year over year on the headline. So it almost feels to me like he's hoping that the inflation data comes down without a rate hike. And I guess he feels that the lack of progress, as he framed it, during the first quarter is going to be transitory. So we'll see. With oil prices at $80 a barrel, I'm not really sure we're going to see the inflation numbers come down in a sustainable way below 3%, particularly not on the core numbers. So the markets, as you correctly pointed out, love this because there was fear of a lurch toward some suggestion of maybe contemplating a rate hike, and that absolutely did not happen. And so you just saw everything go vertical to the upside. You know, stocks went up a lot, junk bonds went up a lot. I mean, we had corporate bonds and emerging market bonds down earlier in the day, and they're now significantly in the green. So this is a interesting thing because the big pivot that started everybody getting happier was November 1st. And interestingly, rates are up a little bit since then, but not very much since then. So we've basically had rates go up and then come back down and go back up again. We've definitely been in a trading range for the fixed income markets and more recently sort of the equity markets as well. And this meeting and this press conference suggests to me that that's going to be sustained.
It certainly sounded like I guess we could say, a not yet chair versus a not at all Chair, at least when it comes to rate cuts. I want to note going in that Goldman is still sticking to its view of 2 cuts because they say the 2 pillars of disinflation are intact, those being lagging housing data and the fact that we don't have any more supply shocks. I'm curious as to what your take is now. When do we get the first cut, and how many will we get this year?
It seems unlikely that we're going to get 3. That was in the Fed's dot plot back in March. I actually, based on what we're seeing in the inflation market and commodity prices, which have been weak recently, but they're pretty much at their 200-day moving average. Oil is up. I kind of feel that the base case now is 1 rate hike for this year.
Cut.
And I certainly don't think it's...
You mean cut?
Sorry, yeah, cut. Yeah.
Freudian. It's a Freudian slip.
got it backwards. But I don't think it's coming in June. I just don't see how that could possibly happen. There's just not enough data, and he certainly respects the fact that, I mean, lack of progress on inflation. That was not unanticipated that he would say that, because he can't disrespect the data. I mean, it is what it is. But I thought one interesting takeaway that I got was he mentioned that a couple tenths in the unemployment rate would not be a catalyst for easing. I've had the feeling that he needs the unemployment rate to get up to 4, maybe 4.2 even. And so we'll see what happens there. The unemployment rate has been up a little bit, but clearly it's not to the point where the inflation fight is less important than as the dual mandate, because the jobs part is behaving quite well, and the inflation rate clearly is the one that is lacking progress, as you put it. So I'm going to lean on one rate cut this year. I certainly don't think 3 seems very likely at all. So that's where it is. I think that higher for longer seems like the mantra continues, but without a rate hike. So this is a pretty good environment. The type of strategy that we've been advocating and implementing seems like it's going to keep working. It's been working really well for the past 6 months. And that is, that you can get pretty good yields by investing in securities in the fixed income market that aren't that risky. I'm not talking about CCC junk bonds or even single B junk bonds. I'm talking about things like single A, triple B, maybe high double B, that are priced off of the short end of the curve, or say off the 2-year or the 3-year part of the curve, where you can get yields that are in the mid-7s without a lot of risk. And that seems like it's going to be a very comfortable place to invest without a lot of volatility. So you want to take advantage of this inverted curve, which has been inverted for a very long time now. It's one of the longest inversions in the history of the bond market in modern times. And it looks like it's going to continue for a while. So that means that you can get decent returns without a lot of lost sleep by staying in some credit securities, but really pricing off the short end of the curve. So we've liked bank loans in the double B area. They continue to do well. We like consumer receivables, parts of the commercial real estate market, away from office. These types of things can all generate 7.5%, even 8%, depending on how much risk you're willing to take. And once again, with some uncertainty having developed, maybe it's going away now with this Fed meeting today, but for retail investors, closed-end funds have gone back to trading at discounts broadly, and with some leverage involved there, there's double-digit yields available without taking a ton of credit risk. So this seems like a pretty good environment for moderate risk assets, and it seems like we should probably not have a terribly volatile environment before the next Fed meeting, which I know you're coming out to Doubleline for the next Fed meeting. It'll be fun to do it in person.
Yeah, I'm looking forward to that. What about the shorter end of the curve, maybe the belly of the curve, even if you think that, I mean, Powell's all but telling you without saying it that they think the next move's a cut, right? I mean, they're pretty much alluding to that. It's just a matter of when. So if you think that rates are going to go down later in the year, what about treasuries now?
Well, I don't really like the long end of the Treasury curve right now. We had been owning some long-term Treasuries. They rallied a fair amount from October. And now we're more interested in, say, the 10-year than the 30-year Treasury, and liking the belly of the curve, as you say, pretty well. And pricing and assets that are priced off of the 2-year and the 3-year, you don't have to go into junky credits. You can get the yield of the high yield bond market to a no default scenario, basically in single A securities that are priced off of the 2- and 3-year part of the curve. So that's what we really like. We haven't had a lot of changes in our portfolios since last we spoke, Scott. We've shortened our duration a little bit because we thought rates were a little bit too low and the 10-year got into the 3s as we suspected was going to happen. But now that we're up at 4.6 and we lost the 5 handle on the 2-year after the Fed meeting, but those are pretty attractive returns for the risk that you're taking, and the volatility just hasn't really been there. Since November, the volatility in the bond market has pretty much dissipated. I mean, a couple of years ago, rates were 200 basis points lower than they are today, but they've certainly plateaued. I mean, we're basically, in many parts of the curve, very close to where we were, really been in the range for the past 6-7 months. So it's a low-risk environment, and it's appropriate that we got a big equity rally because everyone was scared that, the Fed might mention a rate hike, and that absolutely did not happen. So I think we have to characterize the Fed today versus expectations perhaps yesterday as being incrementally dovish.
I'm going to come back to you in just a second, Jeffrey, because on that note, Steve Leisman's out of the room now, and I quickly want to go to him. That really is the takeaway, Steve, right? An incrementally more dovish Fed chair than I think the market was clenched up in fear of.
Yeah, I think there was probably some pricing, Scott, for a Fed that was maybe, more likely to talk about rate hikes, and that's not the case. And I think it was critical when Powell answered my question and said, you know what, I still have confidence in inflation coming down. Let's listen to that.
My expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen.
So the idea being that I think, as you said earlier, Scott, he said the next move being a hike is unlikely. It means rate cuts are still possible. I think it's worth talking about, Scott, when you asked Jeff about whether 3 cuts this year are likely. Well, we're in April now, right? So you know what? 30% of the year is gone. So that question is 30% less significant. I think what you want to be thinking about is over the course of a 12-month period. I don't think Jeff stops his books on January 1 or December 31st. And it's interesting to me to look down at a 1-year that's trading at 519. You know what? If we get on the trajectory on the path that Powell says we're going to be on, that may be a rich bond right there right now in terms of how it's priced in terms of the yield being so high. So, and I'm looking down the curve at like a 480 in Fed funds futures for next year. So anyway, it's time to start thinking about a longer period of time than just this year. Yeah, we probably lost 1 or 2 cuts this year, but over the cycle here, over the next period of time that's still within investors' horizon, certainly there are terms for it out in the bond market. It's something we're thinking about. That said, let's listen to everything Powell is saying. He's not, I think the word that was used by Jeff, incrementally, that's the right word. There are still some pretty hawkish comments out there about the lack of progress and how cuts are not for sure and dialed in.
Yeah, good points, as always, of course. Steve, thank you. That's Steve Leisman, our senior economics reporter. Jeffrey, I'll turn back to you. The other moment I think that people are calling a moment was Powell addressing the S word, stagflation, to which he said, I don't really understand where that's coming from. I don't see the stag or the flation. What's your take on that?
I agree with him. I really don't understand people talking about stagflation at this moment. I actually heard somebody on the radio earlier this week actually say that the economy is shrinking and inflation is going up in real time in a measurable way. I mean, obviously the economy is not shrinking. 1.6 GDP isn't great, but it's certainly not shrinking. And we see that the GDP now for the second quarter, although it's very early, so it'll probably get revised substantially, but it's up in the high 3s. So the economy is not shrinking, and the inflation rate, it might be at 3.5%. But that's not exactly Jimmy Carter inflation. That's not 2022 inflation. Inflation is clearly less. Now, the thing that is, I think Powell is onto correctly is I think everybody, myself included, thought that shelter inflation rent inflation would come down faster than it did. Because the Zillow index and the apartment rent indices, they came down multiple percentage points, and they're down in the 2s, 3s, and 4s, having been up in the 8s and 9s, but yet the owner's equivalent rent stays remarkably high. We got some home data yesterday, and it said that home prices were up, depending on what zip code and what district you're in, but something like 5 to 8%, which sounds surprisingly high given the low volume of turnover and the interest rates. But maybe it's a mix shift. Maybe the data, maybe it's higher price homes are selling. That would actually make sense, because it's the lower middle class and the middle class that's really getting buried by this inflation. And these prices, while the inflation rate isn't that high, the absolute prices are still high. And we have weird things going on, like insurance prices are up massively, which are one of the reasons why the CPI is so much worse looking than the PCE, because we don't have in the core area these insurance prices, and the shelter-in prices in the PCE are substantially lower weighting. So where I am right now relative to the Fed is I'm going to be looking very, very closely, as closely as you can possibly look, at monthly inflation data, and I'm going to be following the oil prices, and I'm going to be following commodity prices broadly, which had shown some strength but are now easing off, and it's nice to see oil back below $80. But if we see 3 4/10 inflation prints, it's going to be very difficult for Jay Powell to make the statement at the next meeting that he's going to get inflation down to 2%, and yet there's no need for any rate hikes. It's going to be difficult to call this inflation reversal or lack of progress transitory come the June meeting, and certainly the one after that. So that's going to be the story, I think, for the second part of the spring into the summer of 2024.
You know, if you listen to Powell's tone and you read into the demeanor and such, he definitely comes off exuding this confidence that he still thinks they can pull this off. And this being the soft landing, because he does expect that growth is going to remain strong enough and inflation later in the year is going to get down closer to target. You've been looking for a recession, albeit suggesting it was, getting pushed out. Do you still hold to that call, or are you changing that?
I am on the fence as to whether we'll get a recession in 2024, largely because the unemployment rate has been so stable. I would be very concerned if the unemployment rate went up by another 3 or 4/10. I think that would lead to a recession sooner rather than later. But we haven't had that happen yet. In spite of the fact there's been all these layoff announcements, it is weird that the weekly unemployment claims never change. Here we have this economy that has its ebbs and flows, and yet we get the same on Thursday. We get the unemployment claims, and they come out almost exactly the same every week. My friend Jim Bianco wrote a piece on this, saying this is almost statistically impossible. What is going on here? That it's always 212,000 unemployment claims every week. But those are the numbers, and unless there's something wrong, and they're going to be adjusted very substantially, and there is some evidence for that. I mean, there is data that's a lot weaker. The household data is a lot weaker than the establishment data. There's this BED data that tends to lead the establishment survey, and that's looking strangely weak compared to what's been happening in the establishment survey. But for now, those layoffs don't seem to be. They seem to be offset by hiring. So we have a labor market that's in balance, even though it seems with the inverted curve and how long it's been inverted and these higher interest rates, you would think the economy would have weakened. But we still have all of those distortions from the COVID response. There's still a huge M2 supply. It's still way above the trend that it would have been if we hadn't bulged up the M2 in 2020, 2021, 2022. We'd have had much lower M2 supply than we have right now, even though it's not really growing robustly anymore. So a lot of these things got way out of whack, and it's taking longer. And Powell acknowledged it himself, and I give him credit for that. That this normalization is taking longer than anybody expected, including myself and including Jay Powell. So I think we need the unemployment rate to go up, and it hasn't really happened yet. So that's number two. Number one is the inflation data. That needs to come down. And I don't really have Jay's confidence that the inflation rate is going anywhere close to 2% by the end of 2024 on a year-over-year basis. I don't care what you look at, whether you look at core or super core or PCE. I don't see any of them going to 2% this year.
I mean, on that note, do you take the Fed chair at his word that it's 2% or bust? Or do you think that they'd actually be willing, even though they're not going to say it, to accept a higher target now rather than what the alternative might be, and that is to ruin a good story that they'd like to be able to tell?
I think that he's doing a little sleight of hand with his inflation numbers, as I said earlier. He's making the claim that the inflation rate is in the 2.7. He cites the PCE. And many other inflation measures are in the 3s or 4s. And you'll remember the 3-month annualized trick that was behind the rhetorical pivot back November 1st. I mean, no one wants to talk about 3 months annualized now because it's not pretty at all. We had CPI come in 0.8 higher in the first quarter on an annualized basis than what was anticipated just 3 months ago. So I think that he's going to have to hike rates unless this transitory lack of progress reverses. And I don't have the same level of confidence that he has that that's going to happen.
And even with all of that, I think one of the headlines, my takeaway, at least from my conversation with you, is that Jeffrey Gunlach is bullish on risk assets, at least in the near term.
Moderate risk assets. I don't like really risky stuff because I think higher for longer is going to start taking some of the bodies out. But I do think that in the medium risk assets, I am positive for at least into the next meeting.
Okay, where would you put equities, for example, on your scale?
I think I'm sort of neutral on equities, but I have a very I don't like index fund approach at this time. I continue to like sort of Japan, Mexico, India as long-term holds, and I'm not a momentum guy, and I know that momentum has been a winner for the past 18 months at least, but I think it's not really leading the way anymore, and I just think valuations, while not excessive, I think they're on the rich side, and they really kind of need this Fed story to play out. But I think in the near term, we at least have the wait and see. We have the time on our side because the Fed has supported a lower volatility environment, I think, for the next several weeks at a minimum.
Speaking of momentum things, gold, you talked about oil for a minute, right? We seem to be on this march, towards 90. And then the dollar. How about your outlook for all three before I let you go?
Well, I've been bullish on gold. I talked about it in our roundtable prime here at Doubleline the first week of January. I didn't think we'd go up so quickly. I mean, it went up to 2,400 in the blink of an eye. That's a pretty big run. But I would hang on to gold. I wouldn't be a seller. I'd probably wait for more like 2,200 to be a buyer. But I think that's fine. I think the dollar is going to weaken, but it needs the recession to weaken. And in the near term, the dollar appears to be stable, very stable, versus most other developed currencies. So I don't have much of an opinion on the dollar. And then what was the other you wanted to?
Oil.
Oil seems very, very stable at about $80. I think that if oil went to 90, as you suggested it might, or certainly to 100, the Fed's going to have a really big problem. So that's the biggest wild card out there in kind of the uncontrollable commodity markets. If oil puts on another $10, $15, $20, there's no chance you're going to get to a 2% inflation rate, as Jay Powell is hopeful for.
Jeffrey, we'll leave it there. And the next time we meet, we'll be in person, as you say, at Doubleline in Los Angeles after the next meeting. I look forward to that.
Okay, sounds great. We'll have a good time.
All right.
Good luck, everybody.
Well. Thank you. We'll see you then. Jeffrey Gunlach. Let's bring in SoFi's head of investment strategy, Liz Young. Welcome.
Thank you.
So the markets, let's say, halved the gains on the Dow. Remember, the S&P was good for a pretty good chunk of 1%. It's given a lot of that back, if not almost all of it. What do you think's going on, and what do you make of what you heard today?
Well, what I think happened before this meeting is the market had priced in Powell's comments from a couple weeks ago, and he had very clearly stated what he reiterated today, which was we've seen a lack of progress. This is going to take longer than we previously expected. But then what we heard today was it's going to take longer, but we're still going to get there. I'm confident that it's working. Restrictive policy is restrictive enough, and the effects of it are finally being seen. So the calmness that the market has right now, that yields have and that equities have, largely are due to the fact that I think we did start pricing in the possibility of a hike sooner rather than later.
Starting to get worried about that, right?
Absolutely.
Are those fears now gone?
For the time being. I think the other thing that we haven't really talked about yet, he pointed out that he wanted to wait for an entire quarter of data before they really made a statement on inflation. So now, instead of thinking about this on a monthly basis for what the Fed is going to do, I think we have to think about it on a quarterly basis. They want to see trends in the data. So if they're going to get confident to cut or hike, they're going to need to see 3 months at a time of data to feel that way.
Well, I
So
think
now
he was more. I think it was more
time like
citing
that.
the fact that they've had, you've had the three CPI prints that were hotter than expected, as he termed that, basically a quarter's worth of data, which is why it was concerning. Now they're also working against the clock and the calendar. Because of the election. They're not going to be phased, he says, by necessarily the time frame of that. They're not going to be political.
Right.
And he made the point yet again, as he has consistently done. But you, as I said to Jeffrey, you do have the feeling that this is just a not yet, not a not at all
Yeah.
Fed chair in terms of cuts.
I think today that's the case. And I think today that's the right way to put it, because they're just now getting what they wanted. They wanted to see slower growth. If you remember back to the things that he was saying all of last year, at some point we need below trend growth in order to achieve our goal on inflation. So now we got our first quarter of below trend growth, and I think that's a good thing. That's what they want to see. But he did point out that the underlying growth rate is still pretty strong. So if things continue at this pace, all he did today was reiterate, we have no reason to cut yet. And I do think that the bar is very, very high for them to hike. But I am with Gunlach that I'm not as confident as he is that that inflation is going to fall precipitously throughout the rest of the year.
Is what you heard today, we'll take a quick break after I ask you this question. Is what you heard today, does that make you more bullish on, let's just say, risk assets, equities, and other things than you were going in because you were fearful that he was going to be more hawkish?
It does for the near term, yes, because I think he allowed us a little bit more time to wait in this pause, and markets do well during a pause.
Okay. Quick break. Liz Young is going to stay with me, and we'll come back right after this. More reaction to today's Fed decision and Chair Powell's news conference. Plus, we do have Qualcomm and DoorDash. They're among the key names reporting at the top of the hour. Let's not forget about Apple tomorrow, too. It's a very busy week. We go in the market zone next.